This week on 5 Minute Financial, we're going to talk about something that everybody loves to talk about: fees. Starting this fall, you'll start to see on your statement, assuming you have some sort of investment, the dollar value, not just the percentage, but the dollar value that your advisor is collecting off of your dough. So, we're going to talk about that, how you can use it to your advantage, and how it's both good and bad for our industry. Very good. All right, so let's start first and just talk about all the fees associated with investing, specifically with regards to any kind of pooled investment here in Canada. Now, that applies to mutual funds, that applies to seg funds, that applies to various wrap accounts, but the basic premise for most of them is the same. A lot of them are available with some sort of sales fee. If you go into the bank or buy directly, sometimes that's not the case, but for a lot of people, there's either a front-end fee, which is a fee that's deducted off the top, or a back-end fee, which is deducted later and declines over time. This is called front-end and back-end because it's at the front and the... Okay, we can skip past that part. The other thing that's bugging people and what's bugging the regulators is the ongoing management fee. Now, the ongoing management fee is called the MER, the Management Expense Ratio. Management Expense Ratio. And what that is it includes both the money that the advisor makes and the money that the investment firm makes. So let's dig into this MER just a little bit. The portion that includes for the advisor is called a trailer fee, and it ranges from 0.25% to 1.25%. Now, the reason I like that is that it links the client's interests with the advisor's interests. So if the client is losing money, the advisor makes less money, and if the client is making money, the advisor makes more money. So it's a win-win or a lose-lose situation, and even the most jaded regulator has got to see that that works well for the client. The issue is not the fact that it's linked like that. The issue for a lot of people is that it's embedded, it's hidden. People don't forget that it's there and they don't know what they're paying their advisor. So in that aspect, this new regulation is actually a great idea because it's going to expose a lot of problems that people are facing, or a lot of problems they don't even know about yet. And the idea would be, okay, if that dollar value is what I'm paying the advisor, what am I getting for that? So that's what we're going to talk about next. Okay, let's say you crack open that statement and you are amazed at the amount of money that you're paying your advisor. First off, it's not an increase. It's what you were paying them before. That may be cold comfort, I don't know. But you don't have to worry about it being some additional cost. All it's doing is being stated for you. Now, what are you getting for that? Because the price, the dollar value you're spending is not actually the issue. The issue is, are you getting good value for those dollars? Based on 26 years of abusing clients with various fees, I've come up with, what I believe to be a half-decent list of what you should expect from an advisor. First and foremost, though, you need to be able to trust the person you're working with. You have to make sure that they're putting their interests behind yours, that the focus is on helping you achieve your goals, and that what that means is that they have had to spend the time to help you determine what your financial goals are. So if you're going to retire in 25 years and you want to have X amount of dollars and you want to pay this off and you want to send kids to school and you want to own a winery, whatever those goals are, the advisor has to know about it and has to sculpt the investments to suit those particular types of goals. Secondly, he has to keep himself up to date, or herself or himself up to date with changes. And that means changes to your personal situation, changes to the investment conditions, changes to the tax laws, changes to the current investments. You have to be kept up. I know clients hate this, but you have to be kept up with what's going on inside your portfolio too. Now, no one cares about this, of course, until their stuff goes down, then they really care. But it's important you care all the time, not just when it goes down. Third, you want to make sure that there is some clear strategy so you know what's going to happen going forward. That's the key things. Now, with these dollars that are being reported now on your statement, you should be aware that this is only approximately half of what your total fee is. The other half goes to the investment firm, and that's a whole separate discussion and something we should get into. But even if you don't see any fees, don't think you're not paying a fee. Of course you are. There's just no advisor involved in that particular process. So the key thing is, when you look at those dollar values, think about, are you getting your dollar's worth from the advisor you're with? And if not, talk to them. I should let you know that I am licensed as a mutual fund salesperson and an insurance salesperson, and I'm a certified financial planner. So that means that I have certain biases built into these things. I believe that it's actually the best way to manage money for clients. That's why I'm doing this. But there are obviously other views, and you should be aware that most of the teams that I work with charge management fees and sales fees and trailers and all of those things that make everyone suspicious.